by unanimous agreement, the Fed decided to keep rates unchanged. Benji Heyer has the details.
So, no change. A pause again by officials here in the nation's capital. Following 11 straight rises from March of last year, interest rates will stay between 5.25 and 5.5%. That's where they've been since July 2023. The Federal Open Market Committee waiting to see if its strategy to contain inflation is working before it considers tightening monetary policy even more. Its decision, a unanimous one to maintain current rates, comes at a delicate time for the US economy and global financial markets. There's war in the Middle East, warnings of renewed oil price volatility, and we've seen a recent bond market sell-off, all of these complicating the outlook. The range of uncertainties, as Jerome Powell calls them, means further action could well be warranted if there's new evidence that a fall in prices is in fact stalling. Inflation has dropped from a 40-year high of over 9% to just shy of 4%. Yet that's still double the bank's 2% target.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
Inflation's been driven largely by what the Fed says is solid growth. GDP accelerating almost 5% in the third quarter, a strong pace, the Fed says, with consumer spending far more resilient than expected and unemployment historically low. Policymakers, in a statement that they put out on Wednesday, recognising that increasing rates down the line, were they to choose to do that, would likely weigh on economic activity. In other words, it could dampen that growth. Benji Heyer, CGTN, Washington.
The U.S. Treasury Department plans to accelerate the size of bond sales to deal with the heavy debt load and rising financial costs. The announcement comes as yields are at their highest since 2007. That's making some in the markets worry about the high cost of borrowing. The Treasury will auction off $112 billion of debt next week and also refund $102 that are set to mature November 15th. They will also increase the auction size of different maturities in Treasuries. And we're going to check on how the markets reacted to that big Fed decision. John Terrett in New York.
After the closing bell on the Wednesday session, Qualcomm, one of the U.S. chip makers, gave us their earnings. They beat on the top and the bottom line, and their guidance for the fourth quarter was pretty strong. Shares up 4% in the after-hours market. The big story of the day, of course, was the central bank, the Federal Reserve, keeping interest rates on pause for the second straight meeting. So the range is 5.25% to 5.50%. They are upgrading language about the strength of the economy from solid to strong, which is actually quite a significant thing for the Federal Reserve to do. They're being highly attentive about what they may have to do in the future regarding combating inflation. They say there's no talk of any rate cuts, not even among themselves, and that we're going to have to live with higher interest rates for longer than Wall Street had originally thought. The decision on Wednesday was apparently unanimous. The markets loved it. Dow up 0.7%, NASDAQ up 1.6%, S&P 500 up 1% at 42.37, and a general sense of relief on the markets, and the possibility being raised now of a year-end rally, known better here as a Santa Claus rally. On Thursday, only one big thing to deal with: earnings from one of the biggest companies in the world, and probably the biggest. It kind of depends, doesn't it, on a daily basis, and that will be Apple. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more about the big Fed decision and the impact on the U.S. economy, Arthur Dong joins us, professor at McDonough School of Business at Georgetown. Good to see you again. Welcome to the show. Look, I'm going to be as simple as possible. The Fed basically said, we have done enough for now. So the stocks then rally, bond yields seem to pull back, albeit for slightly different reasons. But the bottom line is the tension and the stress of getting into this meeting seems to have dissipated, and the world seems happy with the Fed's decision and his speech later.
Yes, absolutely, Phil, and it's always great to be with you here on the show. Yes, the markets were waiting with bated breath in terms of what Jerome Powell was going to announce today, but it was anticipated that there would be no continued upward movement in interest rates. So the markets greeted this news, quite warmly. And as you saw, as indicated by your previous commentators, all the indexes rose today as a result of this news.
So the other argument, too, is everyone's been calling for a recession. In fact, I talked to our other anchor, and she was asking me about, well, what about the recession? There's no recession. Things are good. Unemployment is low. In fact, the other flip side of this problem is they're still trying to slow the economy down from this 4.9% GDP growth. So we are very far from any recession. And there are people who are crying for a recession. I don't know if they want one or not, but they keep saying, well, it's going to be this quarter, it'll be next quarter, it'll be 20. Well, look, eventually you will be right. You will get a recession, but you can't possibly wish for one, and there's no signs that we're in one or near one.
Clearly, as you stated, Phil, there have been many prognosticators who have been sort of doom and gloomers, anticipating that the end of 2023 would result in a very strong recession. But all the naysayers have been proven false so far, as the economy in the United States keeps on roaring forward. And just as you said, employment is at historic highs, and there is actually more jobs available than the number of employees here in America to satisfy those jobs. And just looking around in the labor landscape, you've seen the recent announcements by General Motors and the UAW that labor is in a position of ascendancy right now, and that can only be because they know that that employment and the employment situation and picture here is very positive for employees and for workers. And so all those things taken into consideration sort of adds to this overall picture that Jerome Powell sees, and therefore the soft landing perspective is coming into greater focus amongst those on Wall Street.
I mean, look, all of us have been critical of Chairman Powell for I guess, trying to stop the party too late. But here we are. He has to be given credit for the fact that it appears that we will be headed towards a soft landing. But look, experts, all of us, even regular folks, are shocked by how strong this economy is and how the Fed can't slow it down. We've had 500 basis points of rate increases. We have QT, not QE. We're tightening the market. The banks were supposed to be in trouble. We're trying to bring down the price of home. Nothing seems to work to slow this down. I mean, you have to be surprised as well. And my question is, what does need to happen? I mean, what else can the Fed do to slow things down?
There has to be a serious decline in consumption. And so long as people have jobs in America, they'll continue going to the mall and continue to spend their money on the weekends, going to restaurants and partaking in services and entertainment. So right now, the U.S. consumer is in a good place, and that's certainly demonstrated by the very strong consumption that continues to roll forward. The big sort of unknown and outlier is energy markets. A great deal of uncertainty related to both the Middle East as well as the ongoing war in Ukraine. But so long as there's no further, let's say, shocks, including geopolitical shocks, we can continue to see the United States head for a soft landing.
If I were to tell you that long-term rates would go from 2-3% to where we are now, 7-8% on, say, for example, the 30-year fixed mortgage, which is where we're at, by the way, we're almost at 8%, I would have told you we'd probably see a crash in home prices. We haven't seen that yet. In fact, we saw home prices inch up. And I know what the bulls would argue, oh, there's not enough supply, blah, blah, blah. Great. But that's not the only part that goes into the equation of what home prices are. Why aren't home prices coming down?
It's a matter of supply and demand. Those that currently have homes, they feel that they don't really have a decent option to move. So therefore, they're going to stay in their present home. And as a result of that, that constrains the availability of supply of homes that are coming on the market, either for resale or for new home construction. And as a result of constraint in supply, all things being equal, prices will maintain themselves.
But doesn't life happen? People get divorced, people get married, people change jobs, people move cities, there's family considerations. I mean, ultimately, there's a velocity, we say velocity of money, there should be a velocity of home buys and sells, no?
Yeah, I mean, the U.S. housing market is not as over-levered as it was during the 2008 crisis. And what precipitated the collapse in 2008 was, loss of employment. And as a result, one side of the family losing employment and therefore not being able to support a mortgage. And plus, in the 2008 period, many of the homes that were purchased were overvalued, meaning people took out mortgages that were much larger than their capacity to pay. So now we have a different scenario, as many of these mortgages in the more recent era were taken out in the 2 or 3% era, and thus, a higher degree of financial stability amongst owners, and therefore no pressure to sell.
Yeah, no, I think many of us would agree. Certainly having more supply into the market would help with the affordability issue. Professor Arthur Dong from Georgetown, always good to see you, my friend.